Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in corporate filings, and today we're looking at CNX Resources Corporation. You might not know it yet, but this company just did something pretty interesting with its debt, and we're going to break down what that means for you. So, CNX Resources Corporation, a company involved in natural gas, filed a report that tells us about some recent financial moves. Think of it as a company announcement, but for the official record, they've been busy, and this filing is like a peek behind the curtain. The main event we are looking at here happened on the 17th of December 2025. This is when a few important deals were finalized. CNX is essentially trading some of its long-term debt for actual company stock. What does this mean in simple terms? They had about $122 million worth of debt, specifically these convertible notes that were due in 2026. Convertible notes are like loans that can turn into stock under certain conditions. Now, instead of paying back all that debt with cash when it is due, they've made a deal. They convinced some of the people who lent them money, the note holders, to swap that debt for a combination of a little bit of cash, less than $1 million actually, and a whole lot of their own stock. We are talking over 9.5 million shares of CNX stock. This whole exchange, this swapping of debt for stock, was all wrapped up and completed on the 17th of December 2025. It is a strategic move to clean up their balance sheet. The filing notes this as unregistered sales of equity securities. What that means is they issued new shares of their common stock, but they did it without having to go through the usual formal registration process with the Securities and Exchange Commission. They did this using an exemption in the law, Section C of the Securities Act, saying it was a private deal. This is common for these types of debt for equity exchanges because they are negotiating directly with a select group of investors, not offering it to the general public. The stock they issued is their common stock. This is the usual kind of stock that most people think of representing ownership in the company. And critically, CNX Resources Corporation is listed on the New York Stock Exchange. This means they are a publicly traded company, and these kinds of transactions are important for their investors to know about. So why would a company like CNX do this? There are a few big reasons. First, by swapping debt for equity, they are reducing their overall debt burden. This can make the company look financially healthier to lenders and other investors. Less debt often means lower interest payments, freeing up cash for other things like operations or investments. Second, this allows them to manage their cash flow. Instead of having a large lump sum payment due in 2026, they've effectively spread out that obligation over time through the ownership stake given to the note holders. This is particularly smart if the company believes its stock price will go up in the future. They are using their own stock, which they might see as more valuable in the long run, to get rid of a fixed debt obligation now. Let's talk about the implications for the company and its shareholders. By issuing over 9.5 million shares, the existing shareholders will see their ownership percentage become slightly diluted. This means their piece of the company pie gets a little smaller. However, if the company uses the freed up cash effectively and its business grows, the overall value of the company could increase, potentially offsetting the dilution. It is important to remember that CNX Resources Corporation has its common stock and even its preferred share purchase rights traded on the New York Stock Exchange. This means they are under a lot of scrutiny, and these kinds of financial maneuvers are closely watched. What is CNX Resources Corporation all about? They are primarily an energy company focused on developing natural gas resources. This kind of debt management can be crucial for companies in cyclical industries like energy, where cash flow can fluctuate. By proactively managing their debt, they are positioning themselves for greater financial flexibility, which is always a good thing, especially when market conditions can change quickly. Looking at the big picture, this is a fairly standard corporate finance move to optimize their capital structure. They are essentially saying their stock is a good way to pay their debts, and they are betting on their future growth. It could mean they are anticipating a period of strong performance, or they simply want to de-risk their financial outlook. My take on this filing is that CNX is taking a proactive step to manage its debt. By exchanging convertible notes for stock, they are reducing their immediate financial obligations and strengthening their balance sheet. This can lead to lower interest expenses and improved financial flexibility. However, the issuance of a significant number of new shares will dilute existing shareholders. The ultimate success of this move will depend on whether the company can leverage its improved financial position to drive growth and increase shareholder value. There is always a risk that the market doesn't respond as expected or that operational challenges arise, but for now, it appears to be a calculated move to improve their financial standing. Alright, that is our breakdown of CNX Resources Corporation's recent filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.